Okie dokie, we're going to go through this quiz and see how you did. And overall, not too bad. We're going to explain some of these questions. The first one most people got right, so I'll just give the correct answer was B. Notice the wording, identifiable net assets. That's what we do. Look at the difference between fair value and identifiable net and book value. Of course, multiplied by the percent ownership. Okay. Hopefully you were one of the many who got that correct. The next one, okay, this is where I get tomatoes and thrown at me and eggs thrown in my car. This was a question that was a little bit of a tricky question. It was mentioned briefly in class when we were doing one of the slides, and it's not heavily mentioned in the textbook in Chapter 1, if at all, but it's a forward-looking question, and there's a couple that we had like this, which is why it got tricky. But it was meant to see, are you understanding the concept? So you had the tools to do it, in my opinion, and of course my opinion counts more than yours. At any rate, I think you had the tools to answer the question. All right, after allocating the cost in excess of book value, that's the fair value in excess of cost, or book value, the fair value in excess of book, which asset or liability would be likely to be amortized? Well, bargain purchase is not, cash is not amortized. Trademarks, but there's no known life, so there's nothing to amortize, so we don't do that. Goodwill, we know we don't do that. Lease bonds payable is the only possible answer. And it was mentioned in class that the fair value of liabilities can be different than the book value. We're going to see that more as we go through the next chapters. So that's why it's forward-looking, but it also is something that if you just, well, I think you had the tools to think it through. Okay. There is a curve to the quiz, and this is sort of why. Number 3, most people got number 3 as being that the investor must defer, or rather reverse, previously deferred. That this is the true statement. I think the class didn't do too bad with it. And the concept is that when you, at year end, you defer the unsold inventory at 12/31, you defer it out of income, and it has to be put back into income the next year, meaning 1/1, whatever year it is. So that's the true statement. Okay, number 2, or number 4 actually at this point, most people got right. The answer was E. So I'll move on without doing the calculations since most people got it right. This was a little tricky here. This one is, again, an inventory question, and it shows your true understanding of the inventory issue because it's asking for the reversal. There was one confusion that a student had because I said at the beginning, thinking, and he thought that can't be right because reversing entries are done at the end of the year when you close the books, but technically, if you look at your intermediate accounting, you'll find that the reversing entries are theoretically done at the beginning of the year. All right, how this problem works out is the gross profit of the intercompany sale is $140,000. They sold $350. The cost of goods sold was $210. $140 is the gross profit. Of this gross profit, not all of it has been sold to the outside, so we've got to, at the end of the first year, we have to defer a certain amount. How much do we defer? Well, we sold, 224 was sold, leaving 126 is unsold. Do the math. 224 minus 350 is 126. That's the unsold portion. So 126 of 350 times the gross profit, and then times 30%, the ownership of the investor will get you the number 15,120. The reversing entry in the next year, this is the amount that would be deferred at the end of 1 year, be taken out of income. So the reversal puts it back into income. It's the absolute reverse entry, and that leaves that the only answer would be D. That's putting it back into income, the reversing entry the next year. Okay, number 6. Mad at me yet? All right, wait till you get your score. Just calm down. All right, this one is wasn't too bad. Most people got this right. So I can say that the answer was that dividends received, reduced investment. The right number was 120, and so that was the answer. That was good to see that most people got that right. Basic equity method concept. Most people got this one right also. Answer was A, and that shows good concept of what we're doing with equity method. So very good. Okay, question 8, a little tricky. There are 2 possible answers, which I gave credit for, and that was that the textbook technically says do nothing with the purchase goodwill under the equity method, so that when you're doing equity method, textbook said you do nothing, no impairment check. However, the textbook also says that when it comes to the overall approach of the investment account, you do check for impairment of the investment account, even under the equity method. You don't check the goodwill, you check the company as a whole. So both answers, I think, are acceptable. Number 9. Oops. Okay, this is where I get into trouble again. This question, you have the tools for it. It's, again, a forward-looking question to Chapter 2 and 3, etc., but I think you had the tools to do. The question asks for the total amount of implied goodwill of the company as a whole based on Austin's purchase. So let's see how this is done. Austin purchased 25%. They paid $2.5 million. So that means the following. 25% is $2.5 million. 100% would be, this is the algebra, to get to what 100% of the company would be. Think it backwards. If I paid $10 million, how much would I pay for 25%? That's why this works. Now, the value, the book value of the company, that's what we want to know next. The book value of the company is here, the equity. That's what stockholders' equity means, book value. So the book value is 8. The unexplained difference of the company as a whole is $2 million, so we have to explain away $2 million. How is that explained? Well, here we go. Here's 100, 300, and 400. So 800 is through an explanation of net identifiable assets. So of the $2 million, we've explained 800, leaving 1.2 residual. And so for the company as a whole, the goodwill of the company as a whole is $1.2 million. Okay, now I'm definitely America's Most Wanted. And number 10, most people got right, so that's a good way to end this. And the answer was take advanced accounting all over again. No, that wasn't the answer. The answer was the investment cannot go below 0. One of the rules of the equity method. We went through that in the logic. And that is that. I'll see you next week, and you'll see you're okay. All right.